For the past few years, Canadian investors have been asking the exact same question. Which ETF should I buy? Should it be VFV, VEQT, VUN, XQQ, or should you build a portfolio with 5 different ETFs? 10, maybe even 20. The finance industry loves to make investing feel complicated. But what if the answer is actually much simpler? What if, for most Canadians, you only need one ETF? That ETF is XEQT. Now, before you click away because you think this is another buy this ETF and you'll get rich video, that's not what this is. XEQT isn't the highest performing ETF every single year. It isn't some hidden secret, and it certainly isn't perfect. But it might just be the simplest and most effective investment that the average Canadian can own. Today, I'll explain exactly what XEQT is, why so many Canadians have switched to it, where it falls short, and why trying to build a more complicated portfolio often leads to worse long-term results, not better. So what exactly is XEQT? Let's start with the basics. When you buy a single stock, you're buying a small piece of one company. If that company does well, great. If it struggles, your investment struggles with it. An ETF is different. Instead of owning one company, you own hundreds or even thousands all at once. Now take that idea one step further. That's XEQT. With one purchase, you're investing in companies across Canada, the United States, Europe, Asia, and emerging markets. Technology, healthcare, banks, energy, consumer brands, industrial companies, thousands of businesses, one ETF, one purchase. Instead of trying to guess which country will outperform next, XEQT simply owns them all. And that's exactly why it's become one of Canada's most popular ETFs. Every single year, investors become convinced they found the next big opportunity. One year, it's AI. The next, it's clean energy. Then it's Canadian banks. Then it's US tech. Then it's dividend stocks. The problem? Nobody knows what's going to outperform next. History has shown us something fascinating. The best performing sector this decade often isn't the best performing sector the next. The same goes for countries. The US won't always outperform. Canada won't always outperform. Europe won't always outperform. Trying to predict the winner usually means buying yesterday's winner. XEQT removes that temptation entirely. If one market struggles, another may thrive. If one sector falls behind, another picks up the slack. You're never relying on one company, one country, or one trend. You're simply investing in global economic growth. Diversification is great, but I actually think XEQT's biggest advantage is something else. Simplicity. Imagine trying to build the same portfolio yourself. You'd need a Canadian ETF, a US ETF, an international ETF, an emerging markets ETF. Then every few months, you'd need to rebalance everything to keep your allocations on target. Most people don't do that. Or worse, they tinker with it. They add another ETF, then another. Then they start chasing performance. With XEQT, BlackRock does all of that for you. Behind the scenes, the portfolio is automatically maintained. You don't have to think about it. Your investing strategy becomes incredibly simple. Get paid, buy more XEQT, repeat. That's it. And while that sounds boring is usually exactly what successful investing looks like. Here's something most people don't realize. The biggest reason investors underperform the market isn't because they choose terrible investments. It's because they keep changing good ones. They panic during market crashes, They chase whatever ETF performed best last year. They constantly tweak their portfolio because they think they can do better. Every extra decision becomes another opportunity to make a mistake. XEQT eliminates most of those decisions. Instead of managing 5 ETFs, you manage 1. Instead of wondering what to buy next, you buy the same thing again and again and again. Consistency beats optimization almost every single time. One criticism I hear all the time is, surely it can't be that easy. Actually, it often is, because investing isn't supposed to be entertaining. The more exciting your investing feels, the more likely you're taking unnecessary risks. Building wealth usually looks surprisingly repetitive. Buy, hold, repeat, for decades. That isn't exciting, but it works. Now let's be fair. XEQT isn't perfect, and it isn't right for everyone. XEQT is 100% equity ETF. There are no bonds, no guaranteed income, no downside protection beyond diversification. That means when markets fall, XEQT falls too. Seeing your portfolio decline 20, 30, even 40% during major market downturns is completely normal. If that would cause you to panic and sell, XEQT probably isn't the right investment for you. Likewise, if you're planning to buy a home in 2 years, pay tuition next year, or use your money in the near future, 100% stock portfolio usually isn't appropriate. Your investments should always match your timeline. Another criticism you'll hear is that XEQT holds more Canadian stocks than Canada's share of the global market. That's true. BlackRock intentionally overweights Canada. Why? Because Canadian investors often prefer greater home country exposure. It can also provide certain tax advantages and taxable accounts. Could you build something slightly more optimized? Probably. But here's the question that actually matters. Will that tiny optimization make a meaningful difference over the next 30 years? For most Canadians, probably not. Staying invested will matter far more. Here's what surprised me when I first started investing. The biggest advantage of XEQT isn't that it's the absolute best performing ETF. It probably won't be. The biggest advantage is that you'll actually stick with it. A portfolio that's 98% optimal but followed consistently for 30 years will almost always outperform a perfect portfolio that gets abandoned after 2 years. The best investment strategy isn't the smartest one. It's the one you'll still be following decades from now. XEQT is an excellent choice if you're investing for retirement, you have a long investment horizon, you want global diversification, you don't want to spend hours researching ETFs, you value simplicity over constant optimization, and if you're investing through a TFSA or RRSP, XEQT checks almost every box. Low cost, globally diversified, automatically rebalanced, easy to understand, easy to own, easy to keep buying. In fact, if you're ready to start investing and XEQT sounds like the right fit, you can use the Wealth Simple link in the description to open your account and start building your portfolio. If you use that link, you'll also get a free $25 to help kickstart your investing journey. The finance world loves complexity. More ETFs, more strategies, more opinions. But complexity doesn't necessarily produce better returns. Sometimes it just creates more opportunities to make mistakes. For most Canadians, building wealth doesn't require predicting markets. It doesn't require checking your portfolio every day. And it definitely doesn't require owning 10 different ETFs. Sometimes one globally diversified ETF is enough, because the best investment strategy isn't the one that looks the most impressive. It's the one you'll actually stick with. If you found this helpful, subscribe to Wealth Simplified, where we break down Canadian investing clearly, calmly, and without the noise.